Good morning, ladies and gents, and thank you very much for attending February's edition of the Blackfinch 10-minute market forecast, where we look to provide you with a goings-on that's happened as of late, and also those that are going on the horizon line, which they're to look out for, arming you with some of the things you might want to prepare yourself for with your client conversations. My name is Jordan Kent, and I'm the Strategic Business Manager at Blackfinch Asset Management, and I'm joined today by Josh Clayton, Product Specialist for Listed Investments. For today's 10-minute market forecast, there's a number of things we'll be covering. It's important, first of all, to note that this is not advice. This is our opinions, and so please don't take it as such. And equally, the information is for the likes of professional advisors only. There's a few key themes we'll be covering today, that of AI and the risk that the US tech being under threat. The Magnificent Seven, does that have more room to continue its run? The use of equal weight indices, and also the commencement of a global trade war. I will preface this before handing over to Josh Clayton that it's very unlikely we're going to be able to fit all of this content in 10 minutes, so we do beg your pardon. Hopefully you can stick around with us until after 9 to get all of this information, but if you do have to scoot for any reason, we do of course record this and upload it to our website, so feel free to digest it later. But otherwise, Josh, I think it's best to pass over to you. Good morning.
Good morning, everyone. A warm welcome from myself and from the rest of the Blackfinch multi-asset investment team. And Jordan's touched on the themes on the first slide, and what we have to talk today is really interesting. So any questions, please feel free to reach out. So I'm going to walk through each of these now with some supporting charts like Jordan has on the first slide, but there's no better place for us to start than in the US once again. And it's tech stocks that have been in the firing line rather than up in lights like they normally are. And I think it's worth saying straight away that the news on these huge mega cap stocks has become something like a macro event, like an interest rate decision or an inflation print would be. We had the earnings releases on some of the biggest names in the game, like your Microsofts, Tesla, Meta. But the one that caused the biggest upset was actually on the other side of the world, where a Chinese AI startup called DeepSeek brought NVIDIA's long-standing moat into question and set a bit of a reality check on investors' expectations surrounding the current AI hype. In short, DeepSeek announced their R1 AI model that reportedly showed a similar level of quality to Western models at a significantly lower cost. And I'm going to dig into this more now, but it sparked a global sell-off. There was a strong rotation away from tech. And for some context on how strong it was, NVIDIA, they lost approximately $590 billion in market value on the day. That's larger than the entire market cap of something like MasterCard or Netflix or the Bank of America. But since then, and really over the weekend just gone, OpenAI, who are well known for their O1 model that's used in ChatGPT, have hit back with a more modern version of O1 named O3 Mini. And I'm going to dig into this now and the potential application. So let's bring in this chart, and it is quite messy. I'll break it down for you very quickly. The bar chart at the top represents various AI models across the board. And as I touched on, the one many of us know and use today is ChatGPT. That's represented by the O1 model. That's the furthest bar to the left there in black. And this really is the market leader in the field. It has huge scale. It ranks top in terms of quality, according to the index on the screen here. And when we're talking about quality, we mean how correct and useful is the output for users of the application. And then along comes DeepSeek with their R1 model, giving nearly the same level of quality as O1, but from this unheard of, very small scale startup business, which is represented by that light blue bar next to O1. And this really was a shock for investors because the quality looks so strong, but actually the volatility was in fact caused by the chart below. And this shows your input prices, which is like your cost of processing or generating text using the model, and the output price, which is the cost of retrieving and then using and presenting the generated results. So if we look at the chart and we can see it's ranked on cost, the most rightward bars indicate the highest cost, and the O1 model sits right at the end there as the most expensive. But if you look left into that arrow pointing down, you can see DeepSeek's R1 model has a much more attractive relative cost. And this, at the time of the announcement, was revolutionary. You know, this startup had come in and completely disrupted the market, and the potential applications were huge. You know, think of software developers that can now go and use this incredibly cheap alternative that pretty much provides the same level of quality, which is naturally going to help you improve efficiencies and margins. And this, at the time, was what investors were concerned of. They were questioning NVIDIA's moat had been destroyed and the O1 model, as the O1 model uses the chips. I can talk for a while on this, but there are questions. The main one being the validity of the DeepSeek data here. How many chips are actually being used in the model compared to what's been declared? Is this actually the true cost, or is there more to it? And have DeepSeek been selective in what data makes up the quality so they can artificially match OpenAI? But this is all speculation at the moment. There's no telling. But in response, we've since had OpenAI fight back. They've brought forward the release of their O3 mini model. And if we look at the next chart, we can see why. So we have the O1 model on the left. This is just a duplication of the previous figures on that last slide. So there's a $60 output cost, $15 input cost for its use. We've got the O1 mini and then the O3 mini on the far right. And that shows a fraction of the original cost. Now, you can argue this was brought forward to reinforce investors' confidence that they're the biggest players on the pitch. They can provide this high quality solutions at very competitive pricing. And this O3 model has significant improvements in computing power. So it's leaps ahead of the O1 on that quality index. So what does all of this mean? And this is something we've been debating in our recent investment team meetings. I think quite quickly you can ask, does this innovation mean that tech could become more energy efficient? It's going to become smarter, essentially needs less brain power to run the same tasks as previous models would. And overall, will this be less of a drain in terms of energy consumption or capex for the globe? Or what we think is this level of competition and innovation means the software becomes more readily accessible to the world. If you saw a tweet from Microsoft's CEO over the weekend, he summarized this really well, and he talked to what's called a Jevons paradox. Now, this is an economic theory that means technological advancements will make a resource more efficient to use, meaning there's less power needed for a single application. But actually, as the cost of using the resource drops, global demand can increase and therefore consumption. So Jevons paradox. And if consumption continues to climb as demand for these ever-improving chips moves with it, does the need for heavy investment in infrastructure continue? Well, yes, because if you start to think about what they've done with the advancements of the models, there's incredible optimizations on the chips, stronger computing power, more effective algorithms. It can really open us up to things like artificial super intelligence or a higher level of thinking. Humans haven't been able to solve the cure for cancer or anything to trump Einstein. So this is when it gets very, very exciting in the space, but it's all speculative at the moment. But it absolutely reinforces our conviction in things like infrastructure investment, the demand behind data centers and need for significant capex. And this is one of the reasons why it's a key position in the portfolios here at Blackfinch. So this event is obviously very specific to one of the Magnificent Seven. It's been very topical over the last week, but naturally, you can't talk to one without talking about the others. And the question, does the Mag 7 have more room to run, is one that's been debated for some time, but I wanted to dig into that a little bit further. So I think this has become a staple question from clients on whether the Mag 7 has more room to run or if investors should take or trim their profits. I've certainly been asked this a lot in recent client meetings. And before I dig into this, I will caveat and say these businesses are extremely cash generative. And some of these rich valuations have been backed up by results. NVIDIA being the prime example, which has billions upon billions in operating profit. However, these richly valued stocks and DeepSeek has kind of taught us that what can happen when investors are notably concentrated in just a few stocks. We can see these huge swings in volatility. And just on that point, these valuations are pretty much priced to perfection now. So there really isn't any information advantage. So it can reinforce these heavier swings in volatility, so especially over the near term. But the fundamentals are so strong that it could be unlikely they significantly fall in value, but rather the other 493 stocks in the S&P can narrow the gap and catch up. And this is what the chart's showing here. So I've managed to get this from Oxford Economics. We're looking at the 12-month forward EPS growth of the Mag 7 only, which is shown by that red line there, and then the S&P 500 excluding the Mag 7. So your forward EPS is just a measure that's used to gauge a company's growth potential, their profitability. And we can see the sheer dominance in the Mag 7 in 2022. And actually, if you look at the chart closely, you can guess when ChatGPT was released, roughly about that November 2022 mark. And this is where this earnings gap formed. But as we can see, the gap has narrowed recently. It talks to the story I've mentioned earlier, but also that companies and smaller companies are now catching up, especially with Trump's pro-business agenda coming in and giving a boost to more domestic stocks. So what does that mean for investment portfolios? Well, in our view, we believe we need to be mindful of this concentration in a portfolio. So the next chart takes the S&P 500 index. We compare it against an equal weight equivalent. The key difference between the two is the equal weight removes the size bias from an index or fund. So this is ran to the start of the year, so it covers January, and straight away we can see a smoother return profile for an investor. That DeepSeek release is evident from the chart, but we can see more of an exposure to the other 493 companies has helped mitigate that volatility. And actually, if you look closely on that 24th of Jan, we can see that equal weighted index delivered a positive return for the day, whereas market cap weighted continued to free fall. And this feeds into the previous chart where this higher relative weight to each individual stock has actually outweighed the Mag 7 and can continue to be a tailwind for the portfolio as that EPS gap narrows. But of course, we still have exposure to the Mag 7 in this index, and they can certainly still perform well looking forward. But they're just held at a proportionate amount and help more on that diversification front for retail investors. And then the final part to cover today is obviously the weekend's antics, and namely from one President Donald Trump. Before we dig into the slide, I was catching up over a coffee this morning and I saw the original plan of Trump declaring 25% tariffs on Mexico and Canada has been delayed roughly for a month or so, but it looks like that 10% tariff on China is going ahead. So at the time of Trump making the announcement, each country said they would respond in kind and deploy reactionary measures. And I think the most headline grabbing was Canada. They set out tariffs of 25%, which is roughly like 155 billion Canadian dollars worth of American goods. And President Justin Trudeau openly said to the press, he didn't want this in any form. The reasoning of Trump has been questioned. It was all placed over concerns about illegal immigration and drug trafficking, but obviously most of this kind of falls south of the American border, and Mexico didn't come out at the time with their reaction, but said they will. And actually, you can argue they haven't done that to call Trump's bluff, who's since paused the tariffs. But the old question of whether Trump's bark is worse than his bite is the key one that needs answering, because it looks like he's using these tariffs as a negotiation tool so he can claim political victory. But I still think this chart is relevant. So if we dig into it, so if these tariffs go ahead over the coming month, the real impact to the economies are quite pronounced, and no more so than Canada. And this really does show the size and power of the US. So firstly, some caveats. This chart shows the Oxford Economics forecast for both US and Canadian real GDP. We're working under the assumptions that, one, these tariffs truly go ahead without any disruptions. We've already seen it this morning. It may not be the case. Two, that each country reacts as stated in the study. And three, we don't get any more shocks or changes that would impact the forecast. But in both cases, tariffs are contractionary for GDP. They act as an immediate headwind for consumers as well as companies that need to, import US or Canadian goods for production. But there's a key difference between the two. So if the forecast runs true, the US appear likely to shrug off the contraction in GDP over the longer term, but there's a material decline in GDP for Canada. Each of the forecasts is shown by that blue line in the chart, and you can see Canada doesn't quite touch back to the original forecast. Sadly, Canada is quite an export-driven economy in terms of like their manufacturing or autos, so they are going to be hit hard because of that cross-border trade, so they are susceptible to these tariffs. And unfortunately, there's a similar trend on core inflation. I haven't charted it. The core inflation sees a material tick up in the US over the near term, but it levels back down, but it hits Canada harder. We've seen the Canadian dollar reach decade lows and the US dollars really started to strengthen. And this talks to the recent market drawdown we saw yesterday. This really is a currency play here that the dollar is strengthening quite a lot. But if we just summarize, finally wrap all of this up. So what can we say when we're sitting down in client meetings and asking about Trump? Well, this is something we've touched on in previous webinars, but this kind of volatility is something investors may need to grapple with going forward. It's difficult to truly position yourself for these events, but this is where active managers and diversified portfolios can really earn the money. We can mitigate the potential downside risk through the use of something like equal weight indices that we've explored earlier. We can select active bond managers that can pick the right bonds to drive alpha and help smooth the journey of that equity component in a portfolio. And we have the use of things like absolute return funds that can offer you uncorrelated returns to both of those asset classes. I think just over the near term, I believe this kind of boxing match between Donald Trump and Fed Chair Jay Powell that I talked to in a previous webinar will be one of the key talking points for the year. We can see these tariffs being inflationary quite quickly. So this may mean monetary policy from Jay Powell could be more restrictive to fight back spiking inflation if this does happen. So over the near term, we could see higher for even longer interest rates, but there's potential for sizable interest rate cuts further down the line, but I think this is just more of a case of letting the dust settle before making any kind of knee-jerk reactions. And this is all up for discussion here in the investment team. And if any of you want to chat to discuss further, absolutely feel free to drop me an email or give Jordan a call. But Jordan, I won't steal your thunder, so I'll pass you back for wrap-up.
Thank you kindly, Josh. And yes, as Josh has said, we're really keen to hear from all of you. If there's any questions you've got off the back of today's content, or perhaps there's any themes we didn't touch on that you're particularly interested in hearing our opinion on, you can reach out to myself or Josh as individuals. Otherwise, you can reach out to the whole of the asset management team via bfamsales@blackfinch.com. Otherwise, that'll be all from us today. Thank you much for joining. The next installment will be on Shrove Tuesday, which is the 4th of March. And until then, I hope you have yourself a wonderful day. Take care now.